Hey folks, it's Dan. I am sorry I'm having technical difficulty. We have a storm. My videos keep coming in and out. We had a shock. I'm trying to get my system set up because my system keeps going down. So the Federal Reserve, they cut rates, but we have a ton of other data to go through. So, hey, I'm down here, folks. If you can't see me, let me see if I can just go side by side. Okay, so here's what we're going to do. My apologies on how this is looking. Here's what was just announced, and this is kind of a shock. Here's the dot plot. This is the new dot plot out. But there was also some announcement on how the Federal Reserve, yes, they're going to start quantitative easing. So they said that they're going to start buying short-term bonds. Here's what all this means. This is fantastic news. If you're realtors, your loan officers, you're looking to refinance, you're looking to buy. Here, let me summarize all this stuff for you. So again, folks, my apologies for being late. My name is Dan Frio. I'm the host of the Rate Update. I'm also a licensed mortgage loan officer through all 50 states as well as Puerto Rico. So here's what we have going on right now. The Federal Reserve, they came in and they cut rates. But what they did is they gave us two huge pieces of the data that we kind of need to see what their thinking is. Okay, so what those are is right through here, the dot plot. Okay, so this is a little bit different from where we were, and I talked about this morning in this morning's video, but the biggest shock was how the Federal Reserve, yes, I was wrong. A lot of people said, okay, the Fed's going to start printing money again, and I'm like, no, they're not going to print money, and I'll be damned, they're going to start printing money again. I'll explain that here in a minute. So here's the dot plot. So what we're seeing right through here is 2025. So I'm giving credit to this, to Mortgage News Daily. They provide these services through here, and I subscribe to them, love them. But they provided us with the dot plot for today. So the dot plot going into today was the Federal Reserve was expected to bring rates right to where they brought it today. Okay, so we're right on target there. Okay, so now here's the piece of the puzzle. Really gets a little bit shocking. Now, most of them are still saying, if you look through here, next year, most of them are signaling no rate cuts, no more rate cuts next year. But they did come out today and say, yeah, there's potentially one more rate cut in 2026 and one more in 2027. But the markets are liking this. Okay, so let's get over to the bond market. It's rallying. It's up 21 points. This tells the tale. Okay, so here's what's happening. And this kind of caught me off guard. So you're going to have to highlight this one, make some shorts on this one, because I'm going to show you or go through some economics. I'm going to go through Bond Economics 101. Okay, and this is going to teach you everything you need to know about where rates are going to go and most likely the whys. And this is going to change basically my mortgage rate outlook for next year. So here's why. The federal government, they're out of money. So when they print money, they have to issue it, and they usually issue bonds. Okay, you think of when you're watching things, you watch the 10-year Treasury bond and all these things. But what the government's been doing lately was issuing this debt as short-term bills. And think if it was you. You keep having to refinance your house every 1 or 2 years. Wouldn't that be scary to think, okay, what's next year going to bring? So the government has been thinking, okay, we're going to do short-term Treasury bills on a lot of this. And check out a video I did not too long ago. And I brought this up. I said, this is intriguing. Why would you want to refinance you're talking trillions of dollars of debt in short-term maturities unless you kind of know that rates are going to come down. So here's what we're seeing today. The federal government been issuing all this debt on short-term maturities. Well, now the Federal Reserve came in and said today, we have ample reserves, so we're going to start quantitative easing once again. And I was like, okay, I didn't want to hear that word. But what they're going to do is instead of going in there and buying mortgage-backed securities, through here to bring down mortgage rates to those crazy levels we had, years ago, they're not even going to buy the 10-year Treasury. That's where our long-term debt is. They're now going to come in and buy short-term bills. This is genius. Okay, so think of it this way. Okay, I'm going to get a little, okay, if there's kids around, turn it off. So think of it this way. It's a genius move. It's kind of like what you guys are doing. You dated that house or bought the house, married the house, dated the rate or whatever. Now you're looking to refinance. Think of the national debt we have. It's $38 trillion. Okay, so now if you take the national debt, that amount of money, and you say, okay, the rate we had on there was 7. Okay, and then we refinanced that debt at 6. Then we refinanced it at 5. Now we're going to throw all this stuff on short-term debt, in the 2 range. The national debt, well, the interest on the national debt is going to plummet. Just plummet. Think of when you're looking to refinance. You look to refinance. Why? Well, to save some money to hopefully bring down that mortgage payment. A lot of times, even refinancing, it helps you. But then the next year, your real estate taxes go up, your homeowner's insurance go up, and you're back to square one. So if you didn't refinance, that house payment will be ridiculous. So I always say, and then please join me in the description today. Let me know who you guys are, which are. Here's what I've been saying. The Trump administration, like them, love them, hate them, whatever you like. Let's all agree on this. He has an ego. He's built a massive fortune, if you like it or not, in real estate. Okay, so do you think he's going to want the housing market to crash under his watch? There is no way in the world. Okay, so the move they made today I didn't see it coming. I don't know if you saw it coming. This changes my projections. I already has a housing market forecast coming out. So here's now, I'm going to caution those out there before you go out and buy a house. And let's talk about that a little bit. But that's what's going on with mortgage rates or with the bond market right now. So think of it again. The government, instead of issuing all their debt, think of it, you have debt, so you use a credit card. This is like taking your credit card and doing a credit card, what's that thing, transfer. You're at 28%. Now you have 6 months, same as cash. And that's not that good, but you get what I mean. So you're like, okay, shit, I'm going to save $200-300 a month on that can help me quite a bit. You imagine how much money is going to be saved on trillions? Okay, so now the other piece of this puzzle, let's get to the GDP. So now the Fed comes out today and says, we expect the GDP for next year to be 2.8. Okay, so let's see why this is so important. I think this is the chart. This is the stuff here. Let me get me out of the way for a second. This is the stuff the Fed looks at. Okay, the PCE inflation, and they're saying, okay, this is going to be steady. Tariffs are going to do this and that. And also, the national debt has a huge piece to do with this. Over here, the unemployment rate. I'm still saying we're not going to fall off a cliff. Attrition's taking care of a lot of things. Immigration might be taking care of some things. So that's bringing down the workforce. AI, half of my stuff that I do anymore, I can do on AI. Then you go to the GDP. And if we had a negative GDP, there's a ratio that they look at that's GDP to your national debt to this other factor and these other factors. Sorry, I'm trying to get me focused in here. So if you have a GDP that's still very much positive, now you can drive down the national debt, at least the national debt's interest. So if you take the national debt's interest out there and we still keep paying the same payments, again, let's equate it to you guys. You're at a 7.5%, 8% interest rate. I just got an application. The young man's at 8.99. I'm going to work on that right after this. You're at an 8.99 rate. You're like, hey, if can I refinance in the sixes? I'm saving $500 a month. Think if you have a national debt at 38 trillion, you can take your rate from 7 into the 2s eventually. You're going to save a ton. And the interest on our national debt, I think, exceeds 40% of the national debt or something like that. I could be wrong. Don't quote me. In fact, quote me on it. It's huge. So that's what happened today. So we're going to go back. The Federal Reserve cut rates. Let's get the bond markets loving it. There is going to be some adjustments. So here's what I always say. You're going to have instant market reactions to this. Let's go over to what the Dow Jones and all that other stuff's doing. And folks, I am so sorry that my internet's up and down, and that's no excuse. My apologies. You have the Dow Jones. Let me go back to this again. You have the Dow Jones, it's up 300 points. You have the S&P up. We have the NASDAQ teetering right here. It hits record highs every day. Russell 2000. So we have what I call a Cinderella story across the board. The markets are liking this. The VIX is down. This is the anxiety levels on Wall Street. If they didn't like this data, this would be spiking. Oil's helping us on the inflation front. Yes, it's at $58 a barrel. It's up 27 cents today. It's below $60 a barrel. So my outlook on inflation just actually got a little bit better, because we're going to have tariff money coming in. No, it's not going to be the same that we're getting right now, because they're eventually going to be deemed illegal and they're going to have to make some adjustments to that. But let's get over to the final outcome, all this stuff. You're going to have inflation, this area through here, even with the housing inflation coming down dramatically. You're going to have the PCE coming down. Mark my words, market today. I can assure you probably the next time the Fed comes out, mortgage rates will be lower than they are today. So I'm probably going to adjust my forecasts, and I'll be coming out with that next week. But I'm saying inflation's coming down. You might think I'm crazy. Feel free to comment. Unemployment, we're not going to have a huge, massive move there. GDP, the government, the Fed, everybody's saying we have a positive GDP. So if you look at the markets, it's like, okay, this is pretty good. I was actually surprised of, I'll say it, the rate cut. But now we're saying next year there's not going to be as many cuts. We'll worry about that later, because what you're going to see over the next several sessions for the Fed is this. My apologies, I don't get is this. I'll just talk at this point. The Federal Reserve in 2-3 months is going to have a new restructuring. Not the Fed chair. There's going to be one gentleman that's actually resigning or retiring early. So that's going to put another Trump official on the Federal Reserve. Then come May, Chairman Powell is going to step down, and he can actually step down and become a governor. I think he's going to sail off in the winds. So we're going to pick up another, let's say, governor and president that's also going to be handpicked by the Trump administration. I'm not saying it's good or bad. I'm just saying look at the direction that we're going. So you're going to have a Fed filled with people that are on the Fed Trump side. We're going to have a president who is pro real estate, pro lower rates, pro mortgages, pro this. Very good for housing, very good for the economy, because housing is a huge piece of the economy. So the great news for today, and if you guys don't have any questions, we can leave it at this, is the Federal Reserve is now going to come in quantitative easing on short-term bills, not bonds. That will have a long-term effect on mortgage rates, and it will be positive, and it should be positive all throughout the economy. So I always hate to, I hate to say it, but I'm never really a guy that's the half full or half empty. I'm always looking at the positives behind there, folks. I'm not coming in here each day to just say, woe is me, and give you all the doom and gloom. I'm going to tell you the news and then help you maybe manage through it. Because if you watch my channel each day, hopefully you come in, you're trying to figure out what's going on with mortgage rates. You're trying to figure out what's going on with real estate. And my goal is to just help you answer those, not to come in and just say, oh, here's what's happening or whatever. Help guide you make some decisions, what's best for you guys. So if you don't have any questions out there, let me see. I thought you guys would have a ton of questions today. If you have no questions, I will be going off air now to do the closing bell to let everybody know what's going on with mortgage rates today and the whys behind it, and also what the long